We're going to be covering diversification, due diligence, documentation, and prudence, dealing with trust. And I think, again, because you are either a financial planner who does trust management, or maybe you're an advisor to trust because you're an investment advisor, or maybe you have clients that want to have a trust, or clients asking you questions about trust, there's a certain amount of information you need in all of these, and we're going to go through it. Our objectives for this module is you understand the need to diversify the investments of most trusts, not all of them. Discuss the broad term due diligence is used in trust. Understand the need for over-documentation. Yes, I said over-documentation. And describe what is meant by prudence when acting as a trustee. Let's start off with the definition of diversification as used by a trust field and not by investment field. In the act or practice of investing in a variety of securities so that a failure in one or an economic slump overall affecting one of them will not be disastrous. How diversification works in a diversified investment, no matter how the economy does, some asset classes will benefit, so you have less of a chance of the overall portfolio losing a lot at any given time. That's why the diversified investment will provide better results with lower risk. The best diversified portfolio contains some investments such as stocks that are high risk, and so we also give a higher return to offset that risk. It also contains low risk investments like bonds. We get less to lose money, however they give a lower rate of return. And it's similar to what you have in an investment course, but again, this is tailored for trust. Elements of well-diversified portfolio, and this is a good rule to remember if you're doing trust work because they'll keep you out of trouble, assuming you've documented it. And the well-diversified investment generally consists of U.S. stocks, including small cap and large cap, U.S. bonds, including short-term and long-term, high-yield and safer treasuries, foreign stocks, including developing and emerging markets, foreign bonds, including corporate and government issues, commodities, including gold, natural resources such as gold and real estate. And I know that the bottom, personal residence is not considered an investment as it is lived in. Think of it as a consumer product when you're dealing with trust. So you would not put the individual's home in the trust, although if he had a rental or she had a rental unit in the trust, then it would be considered an investment. Definition of due diligence. Due diligence is a process systematically researching and verifying the accuracy of a statement. Or as I put it, is you don't make a statement unless you got documentation behind it. And that is the key to due diligence. It does require a lot of research. For those of you who get involved with the taxation of trust, you're going to find covers a lot of research because not only do you have federal tax laws, but state tax laws you have to deal with. Due diligence steps in reviewing stocks, NASDAQ, and this here is provided as a good guide that I've come up with. Size of the company, revenue, profit, and margin trends, competitors and industries, various valuation methods, management shareholders, including shares held by management, balance sheet examination, stock price history, stock options and dilution possibilities, expectations from experts, risk, and a review of the 10K submitted to the Securities Exchange Commission. Now this is kind of standard. I think any of you sat down who have investment backgrounds, you'd say, yeah, this is a good list, and this is what you have to do. But the difference between here and you giving investment advice to a client in the role of being, say, a registered rep is in this case, you have to document it. I also note that 10K is extremely important for trustees. 10K is probably the basis I used when I would do trust work. Security exchange and the due diligence need to review the 10Q, which is quarterly, and the 10K annually, reports to the companies. The reports the Security Exchange Commission covers such items as stock option, conversion expectations, niches such as technical intellectual property, potential legal actions, and other information needed before buying the stock. As I put it, annual reports are good marketing documents that are written by lawyers and marketing people. The 10K is written by accountants who are scared of getting sued. Compliance documentation that creates standard operating procedures for any regulatory compliance needs an approval, taxation, financing, technical approval, etc. Compliance checklists and confirmation of actions or agreements. And we're going to cover more of that. Why trustees must document. The law of trust has always imposed a duty on the trustee to keep the beneficiary informed as to the administration of the trust and to account for the beneficiary for all actions taken by the trustee. Now, that has always been a requirement. However, in the years that I've been dealing with trust, I think there's a shortage of it. There seems to be lip service given once a year, sometimes even not even once a year. That's a big advantage, I think, of banks and trust companies. They do a much better job of periodically keeping beneficiaries up to date. Without this requirement for proper accounting disclosure, how the trustee will handle the trust affairs, there's little chance of a trustee being held accountable, and therefore the trustee's duties will be breached at will without any means of redress. And finally, the burden of proof is on the fiduciary to show he is or she is fully performing their duties, and the means for such proof is by providing a sufficient and proper accounting. Now, accounting there is much more than you do from a tax standpoint or financial planning standpoint. Definition of prudence. It's a flexible and unspecified standard of care authorizing reasonable discretion. When you hear unspecified, you hear reasonable discretion, that tends to tell you there's going to be a lot of lawsuits in the area. And it was intended to be. It was not intended to be, rather. And it's tended to be noticed, however, investment advisors and trustees that they have a responsibility. And there's two types of prudence you have to do, administrative prudence and investment prudence. Administrative is really the documentation. Investment, of course, is where you invest the money. And an example of the administrative prudence, you must exercise care, skill, and caution. Again, those three words apply to any trustee of any trust in safekeeping trust assets, disposing of trust income and principal, maintaining trust records, keeping beneficiaries informed, and treating beneficiaries impartially. All are requirements under the prudent investment rule, and all have to be documented. In fact, I think there should be a trust procedure called out for it, and overall this level would be at the policy level. Your textbook goes in quite a bit of detail on these areas. Investment prudence, exercising care, skill, and caution in dealing with any aspect of trust investments. Set investment objectives that suit objectives of the trust and needs of the beneficiary. Again, that must be documented, and you should be sure that the trust is clear enough that you can do this. If it isn't clear enough, you have to get a clarification. Act diligently in selecting investments. Let's start over again. Act diligently in selecting investments. Determine the risk tolerance of a trust and appropriate investments for the tolerance. Diversify the trust holdings. Focus on portfolio liquidity. Obtain advice as needed. And ensure investments are advantageous to both the income and remainder beneficiaries. Again, you're going to get some experience with this in Module 2 because you're going to have to prepare a policy. Summary. In this module, we learned about diversification is not always part of the duty of a trustee when dealing with investments. Due diligence is a major requirement is interpreted broadly and against the trustee and the investment advisor. The dangers of not doing the necessary over-documentation. Again, I want to repeat the word over-documentation. And prudence applies to administration and investment tasks of the trustee. Both are very important.